Hello, everyone. Today is May 13th, and this is first session of the May special with Jeffrey Kennedy. I usually, when I present, a teacher who comes to us from the outside, not from our Wyckoff community and not even from Wyckoff analytics, I usually do not like to talk about their bias. I always want to tell you guys some kind of personal experience and why am I inviting this particular person, to come to our community. So I have really two good, warm memories about Jeff. The first one was in 2013 when Jeffrey came to the IFTA conference. I was the conference director, and he presented on the morning after the conference was done, before we went to Napa, and we had like a wine tour. And on that wine tour, we rented the bus, and Jeffrey and I we sat together and started talking markets. And it's like sentence by sentence, after we've talked probably like for an hour plus or something like this. And this was just the basic exchange of beliefs about the markets and trading. And when you exchange your beliefs, you see where you have a lot of common grounds and how you would tactically deal with some of the situations. So it was a very interesting conversation from that regard. And I think from that moment on, I kind of always had such a, admiration for what Jeffrey is doing in terms of the price structural trading. Thinking about how the structure unfolds, because we Wyckoffans also think always about structure, right? So what is the price doing? And then we're thinking about the characteristics, the relationship between price and volume. So in that regard, Elliott wave theory is very close, to Wyckoff structural analysis. So that was the first episode. And then the second one was after I invited Jeffrey to do the first special 3 years ago together. And that was a lot of fun because we kind of introduced a new element to each other through our own trades. And looking at his trades and comparing them to mine, it was evident that we're looking for the same setup, just from different perspectives, different views. We're always looking for something that's going to move. We're always looking for something that's going to move fast. Why? Because both of us actually use options in trading. So the time element, the duration of the trade really matters. But structurally, either this is, wave 1 and 2 retracement, and then the reversal into the beginning of wave 3, or a sign of strength in the backing up action and the reversal out of the backing up action. It's kind of the same idea. You want to be in that momentum third wave. You want to be in that, momentum markup. So that was very interesting to exchange those ideas going through each other's trades. And I'm really, really pleased to have Jeffrey back. And I'm really looking forward to all of the 3 sessions, and especially the ones that are going to involve some conversations about the synergy between the two price structural analysis and also looking at the trades. I want to see where Jeffrey, is going with his trading, and I definitely would like, some feedback on my trades. Jeffrey, with that, welcome to the special. The floor is all yours today. I'm just gonna, interject some comments. It's small spots here and there, but it's all yours. Thank you for being here.
Roman, it's my pleasure. And I remember that trip to Napa Valley myself, and it was quite the memory. So I appreciate the memories. And again, I also appreciate you inviting me to be a part of the presentation, not just tonight, but next week and the following week as well. Before I get too deep into the presentation, can everybody hear me okay and see the slide? This is my cover slide that I'll be working with. Can everybody follow this okay? Just kind of give me a thumbs up. Okay, Nancy, thank you so much. Okay, awesome. If I could, before we get too deep into my presentation, how many of you are familiar with the wave principle? Just kind of give me a thumbs up or a smiley face, frowny face, something like that. Bernard, okay. Anthony, okay. Mike, awesome. Okay, good, good. Okay, so we have a few people that are familiar with the wave principle, and we do have a few people that are not familiar with the wave principle. Okay, well, let's go ahead and get started. And I'll just go ahead and jump right in to the presentation. And what we're going to be doing initially is I want to make sure we're all on the same foundation with the wave principle. Okay, so what we're going to be looking at initially is just the basics. And this slide here is actually a very important slide. This is going to be one of the more important slides I'll be showing you, not just tonight, but also next week and then the following week, because this is where it all begins. This is the foundation of the Elliott wave principle. There are 5 core patterns. Over in the upper left-hand corner over here, you see the impulse wave. Then we have the diagonal, then we have the zigzag, and then we have the flat, and then we have the triangle. Everything that we know about the Elliott wave principle originates from these 5 core patterns. Now later on, we will discuss some of the more advanced concepts of the Elliott wave principle, where we will discuss some of the variations and complexities, but it all begins here. Okay, so at some point, feel free, print this slide off, put it or tape it to the wall next to your computer, and you'll have a really good guide of what idealized Elliott wave structure and Elliott wave pattern actually looks like. Okay, now the wave principle is a form of technical analysis based on crowd psychology and pattern recognition. And the primary value of the Elliott wave principle is that it allows us to basically put price action into a context. Now, the way the wave principle actually does that, offers us that context, is it basically puts price action into one of 2 categories. You have motive waves, and then you have corrective waves. Motive waves, there are 2, the impulse wave and the diagonal. The corrective waves, which we'll be looking at shortly, you have 3. That would be the zigzag, the flat, and the triangle. This is an impulse wave, okay? It's a directional move, waves 1, 2, 3, 4, and 5. And of course, with every pattern that we work with as Elliotticians, each pattern has its own unique set of rules and guidelines. Now, this is kind of important to understand because when I first began learning Elliott, pushing 30 years ago now, I was unfortunately kind of led to believe that there are only 3 rules I need to know when it comes to the Elliott wave principle. And those 3 rules are wave 2 can never retrace more than 100% of wave 1. Wave 3 cannot be the shortest impulse wave of waves 1, 3, and 5. And wave 4 may never end in the price territory of wave 1. And I was kind of taught that, okay, if you know those 3 rules, you're good to go. You know, just you have my blessing, you're good to go. You know everything that there is about the Elliott wave principle. Not entirely correct, okay? Because each wave pattern we discuss, impulse wave, diagonal, zigzag, flat, triangle, each pattern has its own set of rules and guidelines which actually govern wave pattern development. And if you're interested in the Elliott wave principle, I strongly encourage you to get a copy of, I think it's the best book out there on the Elliott wave principle, of course. It's entitled Elliott Wave Principle by A.J. Frost and Robert Prechter. And in that book, you'll learn everything that you need to know and probably more than you want to know about the Elliott wave principle. Now, the second type of motive wave pattern we work with is an ending diagonal. And that's what this is right here. Old school technicians would refer to that as a rising wedge. But under Elliott wave analysis, we put a few more, say, requirements of the pattern that need to be fulfilled before we actually identify it as an ending diagonal. Now, what's important to remember about the ending diagonal is that it is a terminating wave pattern, and it's very limited to where it may actually occur. It can only occur in the 5th wave position of an impulse wave or as wave C of either a flat or a zigzag, which we will be looking at next. Okay, again, 3 types of corrective wave patterns: zigzags, flats, and triangles. It's also important to understand that the wave principle is fractal in nature. And basically what I mean by that is these patterns that we work with as Elliottians, they actually form smaller and larger versions of themselves. So for example, we just got through looking at an impulse wave. Well, here's your impulse wave. Waves 1, 2, 3, 4, and 5. Now that impulse wave basically is wave A of a larger Elliott wave structure that we identify as a zigzag. Now the notation, kind of like the shorthand we use as an Elliottian to identify a zigzag, would be a 5-3-5 pattern, because wave A subdivides into 5 waves, wave B subdivides into 3 waves, and wave C subdivides into 5 waves. These are important for me in being able to identify a trading opportunity, because as a correction, as a corrective wave pattern, it is a counter trend. It serves a counter trend function in the market. And my style of trading, and I'll be showing you some of my own personal trades later on, but my style of trading might be a little bit different than some of you may be used to. I have no interest, and I'll just tell you right now, sometimes I get laughed at, but I have no interest in trying to, say, bottom tick the market or top tick the market. I'm not looking to get in bottom tick. I'm not looking to sell at the absolute top. That's not my style of trading. I'm sure many of you have bottom ticked the market or top ticked the market. You have bragging rights around the water cooler when you do that sort of thing. But as a trader, my primary goal is quite simple. I trade to make money. Okay, so what I focus on as a trader is the easiest or most assured way to make money. And the way I do that is I focus on the trend. What's the trend? What's the daily trend? What's the weekly trend? And if the trend is to the upside, I look to buy pullbacks. And in a downtrending market, I sell bounces. For me, it gets no more complicated than that. In fact, I do not want it to be any more complicated than that. Trading is hard enough as it is without making it more difficult. Now, the next type of corrective structure we're going to look at is called a flat. This is identified as a 3-3-5 pattern, meaning wave A subdivides into 3 waves, wave B subdivides into 3 waves, and wave C subdivides into 5 waves. Again, as a counter trend move, we can look for this formation to be more than fully retraced once complete. The final corrective structure is that of a triangle, easy to identify. They always precede the final move of a sequence, which is why you cannot have a triangle by itself represent the entirety of wave 2. So whenever you see a triangle, and again, easy to identify, it's that sideways price move that you see on a price chart. It'll give way to a pop, a move up. Elliottians refer to that as a triangle thrust. And typically that triangle thrust will represent a 5th wave or a C wave. In other words, it's going to signal the completion. So from a trading perspective, if you see a triangle, it's basically telling you the party's almost over. You got one more good move coming, and then at that point, that's probably when you want to maybe take profits on a position. Okay, any questions so far on what I've done? Now, if I'm going too fast, please let me know. If I'm going too slow, say, Jeff, speed things up. Or if you have a question, I don't know if we have to necessarily hold the questions till the end of the presentation. I would probably prefer not to do that, simply because I don't want to be 20 minutes into the presentation, have you have a question that needs to be clarified, and you kind of just build on the confusion throughout the evening. So any questions so far? And I'll just kind of, while you're thinking about that or trying to type the question, I'll keep things simple. Again, 5 core Elliott wave patterns. That's the foundation. Impulse wave, ending diagonal, zigzag, flat, and triangle. Motive waves identify the direction of the larger trend. the zigzag, the flat, and the triangle, which are your three primary types of corrective structures. Those are going to be your counter trend moves, and those are going to be your trading opportunities in the direction of the larger trend. So are we all good? Okay, now one thing that I do require whenever I do a presentation, and I'm not sure if I told Roman this, is I pretty much insist on having interaction with you. That way it makes it more fun for me, and I think it gives us a more valuable learning experience. So if I don't start hearing from some people, so I'm going to start calling on people. So Ross, Nancy, are we okay? Joseph, George, any questions so far? Okay, Nancy's on board. Awesome. Okay, well, good. We're going to test your knowledge. What kind of pattern is this? Thank you, Ross. I appreciate that. What are we looking at here? Anthony? Owen? Good. Perfect. It's a motive wave. Okay. Now, do you want to maybe take a guess at what type of corrective structure is this? And what type of corrective structure that is? Okay, so the first one, Sean says it's a flat, followed by a zigzag. Okay, Owen, we don't have a triangle here. Flat, zigzag. Okay, awesome, awesome. Good. Everybody, you're following. This is good. Okay, this is an impulse wave. Waves 1, wave 2, wave 3, wave 4, and wave 5. The giveaway, one of the key characteristics of a flat correction, so even though this wave 2 here is a 3-wave move, and wave 4 is also a 3-wave move, the easiest way to differentiate between these two formations is where wave B terminates. Let me try this new little tool that Roman showed me, the cursor. One of the key characteristics of the flat correction right here is that wave B terminates at or near the origin point of wave A. So whenever you see this 3-wave move down, notice where wave B terminates in relation to the origin point of wave A. And if you can see that wave B is substantially lower than the origin point of wave A, then you can safely conclude that this is a zigzag where this would actually be a flat. Okay, moving on. And let me see how that works. Okay, I guess the cursor thing doesn't allow me to move slides. Okay, what do we have here? Bernard, thank you. Yes, there is a diagonal. Nancy, what do you think? Bernard, Anthony, Ted, you want to weigh in? Okay, again, so these are very simple structures, and most everybody here is identifying the overall formation quite correctly. Okay, so we have an initial move up, clearly a flat correction. This move terminates near the prior move. Then you have wave 3, typically within an impulse wave. Wave 3 is going to be your longest wave of waves 1, 3, and 5. That's followed by your triangle, and then your triangle gives way to an ending diagonal. Now, upon the completion of the ending diagonal, you tend to see a very swift, sharp, volatile move back to below the origin point. Now, from a trading perspective, this is very important to me to know, because that means at this point, I'm not looking to really be an aggressive buyer of whatever we're looking at here, and I'm looking more to be, say, proactive at actually managing risk. I want to tighten up my protective stops, or I want to begin scaling out of the position or taking profits. Okay, again, simple structure. Okay, who wants to take a gander or take a shot at this? And also, too, again, I truly do appreciate your involvement and your responses. What do we have here? Mike, are you sure? Zigzag? Perfect. Cattell? Perfect. Perfect, Ross. You guys are getting this. Awesome. I think a lot more of you are more familiar with the wave principle than actually said so. Okay. Whenever you're looking at a structure, sometimes whenever you look at the entirety of the pattern, you can be sometimes overwhelmed. But remember, the best way to eat an elephant is one bite at a time. So when you're looking at a structure and you're initially, say, overwhelmed by the amount of data being offered by the price chart, what I recommend you to do is simply focus on what you do recognize. For example, the initial move down, 1, 2, 3, 4, 5. Okay, I got that. That's a 5-wave move. This is ugly, okay? Ugly price action, more often than not, if you're looking at a price move that looks ugly, and that's an industry term, by the way, it's going to be a counter trend structure. Okay, well, of the counter trend structures that we looked at, what consists of a 3-wave move, followed by another 3-wave move, followed by a 5-wave move? That would be the flat. And then we see another 5-wave move to the downside, waves 1, 2, 3, 4, 5. So overall, what we have here is a 5-wave decline interrupted by a 3-wave move, followed by another 5-wave structure. This is a zigzag, a 5-3-5 pattern, where wave B took the shape of a flat correction. Okay? And this clearly, obviously, everybody knows what this is after the last example. This is still a 5-3-5 formation, but you have a triangle in the wave B portion of the pattern. Okay? So one of the things, again, that I enjoy about the wave principle is because the patterns offer us as analysts and traders roadmaps. Okay? For example, this being an A, B, C to the downside, at this point, what do we want to be? Do we want to be buying the market or selling the market? Let's just say this is XYZ stock and they manufacture widgets, going back to my marketing classes from college. Okay, some of you are saying you want to buy the market. Okay, why do you want to buy the market? Exactly. You want to buy the market because a zigzag is a correction, it is a counter trend affair, and upon completion will be more than fully retraced. It's that simple. So I spend a lot of my time looking at price charts and just simply looking, okay, hey, where do I have 3 waves up? Where do I have 3 waves down? If I have a 3-wave decline, hey, I'm looking for a buying opportunity. If I have a 3-wave advance, I'm looking for a selling opportunity. It's really that simple. It certainly can be. Life, I remember one time, you'd be very surprised where somebody dropped this bit of knowledge on me. I was at a Home Depot or a Lowe's a few years ago, and I ran into, I guess, one of the sales clerks, one of the guys in the blue vest walking up and down the aisle, and we kind of got into a casual conversation. I even forget what it was, but he made a statement that still stuck with me to this day. And we were talking about, or maybe I just was kind of complaining about life or politics or whatever was going on. My sink was leaking, whatever. And he basically just kind of looked at me and said, you know, son, because he was a bit older than I was, he said, like, life is pretty simple, but we make it complicated. And I thought that was absolutely brilliant. And I'm so glad he shared that with me, because I see so much truth in that statement and how it pertains specifically to trading and to good trading and trading properly and trading well and trading profitably. It's very simple, but many times we can make it complicated on our own by looking at too many tools, too many indicators, too many oscillators, trying to pick the bottom, trying to pick the top. Greed, that can mess us up. Fear, that's another one right there. Ego, self-doubt. That's actually what I call the 4 horsemen of poor trading: greed, fear, ego, and self-doubt. That'll get those 4 things. Horrible, horrible combination. Okay, what do we have here? Anybody want to take a guess of this slide? Ah, Mike. Mike, are you one of my subscribers? Okay. Okay. Yes. Okay. Thank you, Mike, for joining me. And just so you know, for those of you who are my subscribers, I cannot wait until next week when Roman kind of takes the lead and starts to tell you and teach you about Wyckoff. And I'm really excited about when he gets to the point, if he will, because I hope he does, share with you some of his trades, because I remember the presentation we did several years ago together. And I can totally just honestly say, and Roman, I'm not trying to be polite here, but I've met a lot of people over the years. I've met a lot of traders over the years, and some of your trades have been some of the most impressive I've ever seen in my career. Phenomenal. So I really can't wait for my students to see what you bring to the table. Just absolutely phenomenal. What we have here, everyone, this is a developing series of 1s and 2s. It's a 1-2, 1-2. Okay, how could you identify or determine that this is a 1-2, 1-2 setup, which would be the onset of wave 3 of 3 to the upside? Well, there's some very subtle clues. Whenever you're looking at an advance, if this were a zigzag, because many of you identified this as a zigzag, what we like to do as Elliotticians, we like to examine the slope of our C wave. And let me bring over my little spotlight here. Okay, so if this were a zigzag, A up, B down, followed by a C, this would be our wave C. What we want to see, or what the ideal, is that the slope of wave C will be less aggressive than what occurred in wave A. Okay, that would be the ideal. In this instance, you can see the angle of ascent of this price move is much more steep than what we see at this point. Okay, also too, one of the key guidelines of the Elliott wave principle is that of alternation, which simply states that a difference of expression can be expected in a similar wave. So whenever if you can remember in your mind, when I was showing you those diagrams of impulse waves where I would have, say, a flat in the wave 2 position and a zigzag in the wave 4 position, that was an expression of the guideline of alternation. Well, if you notice here, what we have is actually 2 zigzags. So what we have is actually the absence of alternation. Those 2 clues are phenomenal in aiding you in being able to identify early on when a potential 1-2, 1-2, which is a very bullish setup, is indeed taking shape. So there are some nuances. It does require a little bit of skill and a little bit of practice to apply the wave principle effectively. But if you simply start and basically make it a goal to master those 5 core Elliott wave patterns that I began the presentation with, you're going to be very effective. In fact, 80% of what we encounter as Elliotticians are all contained in that one slide, showing you the impulse wave, the diagonal, the zigzag, the flat, and the triangle. Okay, now let's go ahead and kind of get down to why we're all here and why I do what I do. I sometimes tell my subscribers, and Mike, you've heard me say this, when it comes to, say, technical analysis, I am an end user of technical analysis. The reason I do technical analysis is to be able to identify a high confidence trade setup. So I then can either buy the market, sell the market, but ultimately make money. That's why I do what I do. Okay, so I'm going to be showing you some of my trades, and I believe next week, again, hopefully cross your fingers, Roman will share some of his. But what we have here is a price chart of serious logic. Okay, in this slide, are you long or short? Because again, at the end of the day, it always comes down to this question: do you have a trade? Do I see a high confident trade setup? If I go long, what are my odds of making money? If I go short, what are my odds of making money? And so really that's what we do as technicians. We're looking at really in front of us. Bottom line, in front of you is the most important thing you'll ever look at whenever you're looking at a price chart. It's price. I'm a big believer in, Mike, you've heard me, and many of my subscribers have heard me say this. I firmly believe that technical analysis is a language. and that the more you understand the language of technical analysis, the better you'll be able to understand the narrative of the market. So you'll already know which way to look. You'll know to look up. You'll know to look down. You know when things are getting maybe a bit top heavy or overbought, or you'll know when things are, hey, basing or bottoming out, and really, rather than getting sucked into the headlines, you know that, okay, hey, I really need to be buying this right now versus, panic selling, okay? Roman, from a Wyckoff perspective, what would be your read on this chart?
Well, I think I would go long here. I'm just kind of debating a little bit as to the possible extension of the wave up. So the low that comes in March, that's a COVID low. It is preceded by an uptrend, and I'm looking at the breakouts in the uptrend. Those are really good breakouts, like in July of 2019, October 2019. Those are great breakouts in the uptrend. So that tells you that there is a strength there, and then the COVID just over exaggerates the reaction. The first swing up of the March 20th low is actually really good. It covers a lot of the reaction retracement that we've had, and then test that is a significantly higher low, another test, and we see how volatility diminishes in August of 2020. So it's when the volatility diminishes after that change of behavior on COVID reaction, that's when we could expect the rally. So the rally most definitely should overcome 75 and 78 resistance, and probably go into that final upthrust where the uptrend ends. So I would have my target at probably like 85, 90-ish cluster, and probably like a swing trade, really quick swing trade right there.
Okay, awesome, awesome. Again, this is one of the things I'm so excited about the wave principle. I just said that, technical analysis, again, is a language, and the better you understand the language of technical analysis, the better you'll understand the narrative of the market. Well, what's kind of cool about technical analysis is to understand that the wave principle is a language. Wyckoff analysis is a language. Candlestick analysis is a language. And you don't need to simply feel like or believe that you need to only learn one language, and one language is actually sufficient. I'm multilingual. I've been doing this. I'm a professional technical analyst. I've been doing this stuff for like 30 years now. So I'm actually well versed in many different, say, languages. And it's always kind of surprising how, or not actually surprising, it just kind of validates my theory, where you can take someone, say a Wyckofian, look at a price chart and walk away and go, okay, yeah, I want to be a buyer. I can look at this chart and say, yeah, I want to be a buyer as an Elliottian. If I was a candlestick enthusiast, I can come up with the reasons why I want to be a buyer. If I'm an old school chartist, Edwards, McGee, and Bassetti, that kind of old school back in 1920 and 30s and whatnot, and do basic chart reading, I can find reasons to be a buyer. So now let me show you what I'm looking at. Or more importantly, this probably speaks a little bit more directly to the Elliott wave principle. One of the biggest problems, mistakes I see newbies or individuals who are new to the wave principle, they try and force a wave count. They'll be looking at a market and they're not really sure what's going on, so they force it, okay? Because counting a market, labeling waves on a day-by-day basis, week in, week out, month in, month out, what you'll come to understand, it's like a long road trip, okay? There are going to be times on that road trip where the sun is bright and shiny, it's the middle of the day, and the road in front of you is clear. And then there's going to be times where it's cloudy or raining, and your vision may not be that clear. And it's important to know that, or we all know because we all drive cars, that we basically adapt our speed as a driver behind the car based on essentially visibility. When things are clear, we kind of drive fast. When it's nighttime and rainy outside or snowy outside perhaps, we slow down. We adapt to the road environment around us. That's what you need to do when you're trading, or certainly applying the Elliott wave principle. Bottom line, if you can't count it, don't trade it. There are so many markets to actually trade that you can take your pick. In fact, you actually have it easy because maybe as a smaller retail trader, you can choose to trade as infrequently as you want and only demanding the best opportunities. I see this as a triangle. Now, the ultimate resolution of the triangle would be for prices to go back and exceed the origin of your wave A. So that would be like 95 or even 100 here higher. Sometimes my trades, though, tend to, some technicals. I like to combine technicals. What you have here is a nice reversal, what I call RSI bull market support. I picked that up from Andrew Cardwell, a very valuable technique on interpreting RSI. Candlesticks, love candlesticks. Many of you might recognize that as a bullish engulfing pattern. The tool that you see here is the Donchian channel that was developed by Richard Donchian. Many of them consider to be, say, the father of trend analysis or trend trading. He actually kind of served as the inspiration to the turtle traders. If you're not familiar with that story, it's certainly a fun one. But one of the signatures I like to look for, and many of my subscribers already know this, is I like to see prices move above the Donchian average and then come back down and look for that Donchian average to actually act as support, and then the reversal. So I'm definitely loving this as an upside trade for several reasons. Again, from an Elliott wave perspective, I like the buy side. From a momentum perspective, I like the buy side. From a candlestick perspective, I like the buy side. And this is just old school chart reading right here. We have a double closed key reversal outside bar. Very, very powerful bar pattern. So I'm looking at this market, and I hope many of you are already one step ahead of me, and you basically realize, what am I doing? I'm building a case. I'm looking at the price evidence. I don't care about opinion. Everybody's got an opinion, and more often than not, their opinions are wrong. Okay, they just stop at the headline. They never do any kind of in-depth analysis. So what I want to do is I want to basically look at this price chart with no ego, no bias. All I'm looking to do is assess, what are my odds of making money? Where's my risk? Okay, for example, because I don't want to take a trade where the risk reward ratio is 1-to-1, where I risk $1 to make $1. If I risk $1, I want to make no less than 3. That's at the actual absolute minimum. And here on the 24th, this is what I did. I bought some calls. I basically either a long put, long call kind of trader. Roman knows this better than I do. Options can be a very complicated trading vehicle for a variety of reasons. I am not an options expert, so please don't ask me questions about options because I simply don't know the answers. I'm just telling you right now. I know enough about options to be dangerous to myself and other people. Okay, so in this instance here, I bought my December 65 calls, and a week or so later, I got out, and it was a nice return, 89% on the position. And I'm fine with that, okay? No, I did not hold the position all the way up to here, and that's fine. One thing that's, and I have in one of my slides, I've got a tip where I actually recommend this or point this out, because this is, again, a misconception among traders or certainly new people coming into the business. You do not have to buy the bottom and or sell the top to make money. As a trader, my job is very simple. Make the cash register ring. If that's making 5% on a trade, I did my job. If that's making 50% on a trade, I did my job. That's all I'm looking to do. Here, I make 89% return in the span of about 5 or 6, 7 trading days. I'm good with that. I'm moving on to the next party. Any questions so far? Does everybody understand the logic on why I did what I did? Harry, what do you think? Gene, George, Nancy? I haven't heard from my Nancys. again, for me, trading is it's no more simple than I trade to make money. And the way I do that is I look for a setup that I believe to be as high confident as possible, period. And I get in, make my money, and I'm gone. Okay. I'm not one of these people that I like to, like, for example, sell and buy and sell and buy. You could, okay, but that's not me. I know who I am as a trader. And let me explain that, because I think this is something that every one of you should spend some time trying to figure out, because some of you have already figured it out. Some of you are still trying to grasp who your identity is as a trader. And what I mean by that is, what markets do you like to trade? Do you like to trade Forex? Do you like to trade crypto? Are you a metals trader? Do you like to trade futures? Okay, what's your time frame? Okay, are you tend to be a short-term oriented or a long-term oriented? Maybe you're really not a trader, but you're more of an investor, where you might make 2 or 3 trades a year because you've got a 1, 2, 3, or even a 5-year trading horizon. What vehicles do you like to trade? Do you trade futures? Do you just straight up buy the cash market? In other words, rather than buying options of, say, Cirrus, you buy 100 shares of Cirrus. So these are questions you ultimately need to understand. I've pretty much traded anything, and I mean, if you can trade it, I've done it at one point or another. Bonds, metals, futures, crypto, you name it, I've done it. For me, who I am as a trader is I like to trade options, okay? And the reason why is because I know specifically and precisely what my risk is on the trade when I put it on. For example, if I buy here, I bought 5 of the December Cirrus calls at like 4 1/4. What is that? Well, let's just say $5. Okay, that's $2,500. Okay, if everything goes to hell, the most I can lose is $2,500. That's my risk, period, end of story. But if you trade futures, okay, futures market, you actually open yourself up to a different kind of risk. And if any of you ever heard of what a limit move is, you know exactly what I'm talking about, okay? So you need to know who you are as a trader. And the reason I say that is because I tend to be a little, I guess to put it politely, a little, say, ADD. I lose attention quickly. So if you're not really capturing my attention, if things are not moving around quick like in a hockey game, I just get bored. So buy and hold, or that longer term, investing, does not fit my personality because I get bored. And when I get bored, I start playing with stuff and start tweaking stuff. And then that's usually when I begin to make mistakes, okay? Why the early exit? Okay, Bernard asked a question, why the early exit? Okay, and it's a great question, Bernard, and the answer is very simple. In my mind, I did my job, okay? That's why I exited. I got in at here on the 24th. That's 1 day, 2 days, 3 days, 4 days, 5 days. In 5 days, I have almost a 90% return on my money, on my investment. I'm good with that, okay? Again, going back to what the 4 horsemen of poor trading are: greed, ego, fear, and self-doubt, not trusting yourself. Think about it. If I just do 1 trade a month, okay, and I make 90% return on that 1 trade a month, how much am I making for the year? How much am I making over a 3 to 5 year period? Okay, with that kind of a track record, I could go to Wall Street and be managing money tomorrow. Okay, this is one of those things where, hey, I'm good with a 90% return in a 5-day period. I'm off to the next game. Or what I do, since the longer term bullish Elliott wave forecast is still positive up to beyond the 100 point, maybe what I do is I just put this on my radar, and if we get another pullback, another 3-wave decline, I'm going to be getting back in, okay? A lot of my trades are just like this. Get in, get the pop, make a quick buck, so to speak, and then boom, I'm off to something else, or I'm going to wait for my next setup. I'm not interested in basically riding the wave, because waves don't last. Okay, and let me be more clear, because I don't want people to misunderstand me. How many of you have been to the ocean and have sat in the sand with your toes in the sand, and you watch the waves come in to shore, to the beach? Okay, awesome. Okay, and you look out and you see the wave beginning to build and build, and then it begins to crest, and then it crashes. Okay, so you can watch surfers, okay, because they're masters at riding waves. Okay, how long does a surfer stay on a surfboard when he's riding a wave? He certainly doesn't do it for 30 minutes to an hour. Exactly. His time on the board standing up is relatively short, because that momentum, that wave that he's riding is, has a definite time span on it. It's not going to be a 10-minute wave unless it's one of those big 50-foot suckers out of Hawaii. Okay, but you get my point. So I like to get in, ride the momentum, and then step back. That's just my style of trading. Just my style of trading. Okay, now we're going to move on and take a look at some advanced Elliott. Oh, before I continue, Roman, were there any other additional comments that you may have wanted to add to this chart?
Well, I'm just kind of like listening to your tactics about trading. A lot of it makes a lot of sense. I feel that some of my trades, swing trades, I would rather maybe conduct it like you, just quickly just take it away and go to something else, than just expand it into like more extended trade. But I think it's also environmental. In some environments, a shorter swing trading is more profitable than in another. So, yeah, kind of depends.
I agree.
The question that I had here is, I'm looking at the origin of the trade. So I think it's in what, mid-September, late September?
Yes, this would be, it would be mid to late, actually, yeah, September, yes.
Right. I'm wondering what kind of efficiency you would get if your expiration would be, let's say, in November. Because if you're expecting, like a 5-day pop-up type of trade,
Mhm.
I'm just thinking it in terms of the premium because it's always so expensive.
Well, you have a point, okay, and let me explain my logic.
Mhm.
For for um, for about a year or two, my focus was trading weekly options.
Mm.
There's a lot of markets out there that give you the ability to trade options on a week-to-week basis. And for whatever reason, I got seduced by the inexpensive, the cost. Because if you buy a weekly option on Monday that expires Friday, I don't really care what the price of the stock is trading for. You can pick those up for pennies. So for something like this, a $65 trading stock on an option that expires on a weekly basis, you could probably get 100 for 20 cents. Okay. Well, I did that kind of trading, Roman, for
Mhm.
about a year and a half,
Mhm.
trading weekly options. And what I did was I basically lost a lot of money.
Yeah.
Okay. Because what would happen is the move I was expecting wouldn't really occur until the following week. And so it really got to be very frustrating. So one of the things I like to do now is, and also too, and you know this, and I'm sure everybody else knows this as well. When you start pushing 2 weeks prior to expiration, that's really when the decay on the option really begins kicking in. So I like to kind of give myself a window of about maybe 4 to 6 weeks of time in front of me. So that gives me 2 really solid weeks to play with, and then maybe 2 additional weeks if I go for say a 6-week option. So this is why I sometimes buy, like for example, I was taking a position today, and let me see, what is this, May? I think I picked up the Julys. Okay,
Yeah.
that gives me 2 weeks to really, manage the trade, watch the trade, look for it to develop, not really worry about the time decay. And then when I cut it loose, it still has enough time premium in it to still be valuable.
Yeah, it makes a lot of sense. Yeah, all of my weekly options trades also were either extremely dismal or just losses. So I don't trade weekly options either.
I
Uh,
know, and that took me a lesson. I mean, you never learn a lesson unless it comes with a bit of pain. And after I blew up an account or two trading weekly options, primarily because I had a small account, and I saw that I could,
mhm.
I could buy 10 weekly options for $100,
Yeah.
and then I'm sitting there, and I'm rather than doing good analysis, I'm sitting there hoping that the trade works my way.
Hmm.
And anytime hope becomes part of a trading equation, it's a recipe for disaster.
Yeah. Well, it's a very interesting question for me, like specifically exploration, because you always want to optimize the time that you want to spend in the trade. So the next question that I would have is like, it's obviously on the swing traders that use option type of mind. Um, I was talking to a student actually just recently about the preparedness of the stock or the instrument to start going, let's say, up or down with the momentum. So just be there when you are expecting a momentum. And I guess my question is, how does the Elliott principles kind of like reflect that? And then also, what is your personal experience with looking for the momentum trades that are going to happen right now? Because your time frame is, somewhat on a shorter side.
Okay, well, what I look for primarily is okay. Number one, and the way I kind of set myself up, my mentality is I want to take a look at the weekly chart because for me, the weekly chart is the trend. Whatever is going on in a market. Now, in this case here, if we were to look at a weekly price chart of Sirius, you would see that the weekly trend was up, and that really the consolidation that we've seen since the high here was very sideways. So it was kind of simple to identify this as, hey, what we're currently experiencing now is nothing more than a pause in the direction of the larger trend. So really my number one job during this period of time is to do nothing. As a trader, you have three choices, three positions you can take. You can be long, you can be flat, or you can be out short. Okay. We sometimes forget that being flat is indeed an acceptable position to actually take. And over the years, there have been many, many instances where if I had simply been flat the market, out of the market, it would have been the most profitable thing for me to have actually done. So I spend a great deal of time simply waiting, watching and waiting. Ready, aim, 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 fire. I spend a lot of time waiting. So when you begin looking at the real short-term structure here, because following this three-wave decline, that would be my A, B, C for wave E. We move up and then we come back down. Now, if you're into individual price analysis, bar analysis, let me go back to the prior slide. Okay, let me go back to the prior slide. Okay, if you look at, for example, here, you've got some price gaps. The pullback, which is basically down, up, down, so there's a small three-wave move, but you actually see a closing the gap trade setup right here. So you have a three-wave decline, closing the gap trade setup. So now I'm beginning to see, say, the tea or the coffee beginning to boil, so to speak. And then when we have our double close key reversal here, this is really where the price, the chart is confirming the momentum I suspect being there. Okay, so the price evidence is what basically forces me to pull the trigger because I can buy, the close or the open. Here's my stop. I'm risking the range of a price bar. I've got nothing but upside in front of me. And everything did indeed work out. So this goes back to single bar price analysis. Just like I said earlier, technical analysis is a language. That old school skill of chart reading or reading the tape is a skill that's been lost, unfortunately. And there's so much information provided by just a simple open, high, low, close price chart that many of us miss because we're seduced by quantitative analytics or any kind of computer that can do algorithms. And it's really unfortunate, but there's so much information that's in front of you that you simply just don't see because you haven't been taught or trained to actually see it. But it takes some time, but it's very easy. And again, at this point, I think, the 5 up, the 3 down, a small inverted head and shoulder formation, several reasons. We can look at this price action in August, September here, again, many different ways, and come up with, a variety of reasons. I'm building a case. I'm actually building a case to actually do something. If you're having to guess, if you don't ever don't guess, okay? Just either you know what's going to happen, you don't know what's going to happen. And it's okay if you don't know what is going on in a particular market. Some people kind of, unfortunately, subconsciously, if they don't know, they feel bad. If they get something wrong, they feel bad. That kind of psychological system was built into you as a child in school, for example. If you don't know the answer, go sit in the corner. When it comes to trading, one reason I believe successful trading is so hard to really grasp or embrace or find is because so much of it is counterintuitive. For example, right and wrong have nothing to do with making money as a trader. I've been wrong, though. I've been right the market before and have lost money. I've been wrong the market before and I've made money. So right and wrong have no real, implication with what we do. It's how much money we make when we're right that matters, and how little money we lose when we're wrong. Because I can have, out of 10 trades, I can lose, half those trades can be wrong. But on half those trades that I'm wrong, I lose 500 bucks. On the other half that I'm right, I'm making $2,000 to $3,000 a position. Okay, I can make money all day long doing that. Okay, let's go ahead. I know we're into our first hour. Let's move on if there aren't any additional questions. And so far, again, just let me make sure, am I staying on point with what you came to learn? Because I don't want to get sidetracked. I want to make sure that the reason you joined Roman and I for tonight's event and next week and the week after, is this what you're wanting to know? Is this what you're wanting to learn? Okay, we will. There'll definitely be more examples. Okay, Owen, thank you. Mike, awesome. Okay, now we're going to move on to some advanced Elliott wave concepts. Okay, the basic patterns, again, that's the foundation. That's 80% of what you're going to be doing. Impulse waves, diagonals, zigzag, flats, and triangles. Now, each wave pattern has its own, what I sometimes refer to as, yes, Mike, we'll get into Fibonacci. Each wave pattern has its own, personality. And I sometimes refer to those as a variation or complexity. And it's important to understand what those are actually are. Okay, Bernard, we're definitely going to be getting into the interaction between Wyckoff and Elliott. Tonight, though, I just wanted to lay a very solid foundation in Elliott. So when Roman comes in with Wyckoff, you're clear on both. Okay, so just bear with us. We're definitely going to fulfill that that expectation. Okay, so the primary variation or complexity of an impulse wave is what we see as the truncation, or what we call a truncation. And a truncation occurs simply when the wave that should make a new price extreme is unable to do so. The truncation in an impulse wave, certainly in the wave 5 position, is actually exceedingly rare. And when I say exceedingly rare, we're talking about less than 10% of the time, arguably even less than that. But when they do occur, it's important to pay attention, because the reason it truncates is that there's hidden or underlying, in this case, selling pressure, over here, buying pressure. So this is something we need to keep an eye on, the truncation. Truncated waves are going to be more common if you're dealing with, say, wave C of either a zigzag or a flat. Okay, now a variation of the ending diagonal is the leading diagonal. Okay, pretty much the same structure. It looks like in this case, a rising wedge. The substructure can vary a little bit though. the movement can either be these traditional 3-3-3-3-3, or it can be a 5-3-5-3-5. Again, relatively rare pattern. It's a 10% kind of a pattern. And it's one of those patterns that I think is best identified after the fact because, again, exceedingly rare. Okay, corrective waves. We're going to look at some of the variations and complexities of corrective waves. Now, the most common, say, complication you'll encounter or variation of in the correction of a corrective wave is going to be what we refer to as a WXY. Here we have W, here we have X, here we have Y. This is actually referred to as a complex correction, okay? Complex correction is kind of a catch-all. It's basically describing a group of corrective patterns. For example, the double zigzag, which is what you have in front of you. You can also have a double three, which is two flats joined together by an X wave, or a combination, in which case maybe wave W is a zigzag and wave Y is either a flat or a triangle. Even though the name is a little bit misleading, complex correction, all a complex correction is two corrective wave patterns joined together by an X wave, an intervening corrective wave pattern, okay? Now, the time to expect a complex correction is primarily when a single wave, a single correction, is insufficient in correcting the extent of the prior price move. Okay, so if you have a big move up, one of those situations where wave 3 equals like a 2.0 or a 2.618 multiple of its corresponding wave 1, that would be the appropriate time to be looking for a complex correction to actually unfold. Now, what we have here is the expanded flat. This is a variation of the flat correction in which wave B terminates beyond the wave A portion. Okay. Here we have a flat in a bull market, and then we have the flat in a bear market. Now, a variation of the expanded flat would be the running flat. Now, this is a significant wave pattern as well because it kind of touches a little bit on the truncation that we saw a moment ago. Wave C of an expanded flat should terminate below the wave A extreme. Okay. The fact that it does not basically means that this is a truncation. Wave C does not terminate below the wave A extreme. So this tells me that there's hidden or underlying buying pressure. Over here to the right, hidden or underlying selling pressure. This is actually somewhat of a common pattern. Now, I'm not saying common like 60% of the time, but I always keep an eye open for the running flats because they do offer very, very nice trading opportunities. Okay, the double three combination, again, this is just the zigzag, any three followed by the flat, nothing fancy there. Here are some of the versions or variations of triangles. At the top here, you've got your basic triangle. This is a contracting triangle. The barrier triangle, easy to identify. It has a very horizontal BD trend line. And then you have the expanding triangle, A, B, C, D, E, where the AC and the BD trend lines actually expand. Very, very rare formation. I've seen maybe 3 in 30 years. So primarily what you're going to be dealing with would be the contracting triangle, the barrier triangle, or a variation of the contracting triangle would be the running triangle, in which case wave B terminates beyond the wave A origin point. Okay, so any questions regarding some of the, say, variations and complexities? Now, again, when I say variations and complexities, these are formations you're not going to be running into on a day-to-day basis. They're going to be more, more seldom, more infrequent, maybe 20% of the time or even less. So use those variations and complexities sparingly because their real world occurrence is infrequent. Okay, let's go back to having some fun here. Okay, this is a setup or a trade that was kind of I wish I had saved my price chart sooner, but this was a really nice trade, so I thought I would go ahead and kind of discuss it a little bit. What kind of pattern are we working with here? Okay, so and let's start at the high. Whenever you're beginning a wave count, you really want to begin with asking yourself a primary question. Do I see a pattern I recognize? And if you don't see a pattern you recognize, then you either begin at an extreme high or an extreme low. You don't necessarily have to start counting over here. And since this is an intraday chart, I don't have to go to the daily or weekly chart to get an idea, because remember, as a trader, you're somewhat opportunistic. I'm looking for high confidence opportunities. So going from this extreme here to the low that occurred here back in October, what wave pattern is that? Sean, Sharon? Sean, yes. Sandal, are you sure? Okay, Mike. Either one works. Okay, Bernard, expanding flat. Okay, now remember, with an expanded flat, wave B needs to terminate beyond the wave A origin point. So in this instance here, it doesn't. So it really doesn't meet the requirements of an expanded flat, but you're on the right track as far as the flat family. And the giveaway is the initial decline. The initial decline is best identified as down, up, down, A, B, and C. Okay, so with a three-wave down initially, and then we have this move up. Okay, now to truly qualify for wave B of a flat correction, wave B must retrace at least 80% of wave A, and it clearly does in this case here. And then that's followed by an impulsive move to the downside. So the way I was looking at this at the time was pretty much this. Here's my A, here's my B, here's my C for A. The larger pattern is a flat. Here's my A, here's my running flat B. Here's a good example of a running flat. Here's my 5-wave move up for wave C. Here's again a leading diagonal, 2, and then 3, 4, and 5 into the low. This was the wave count I was working with and operating at the time. Can everybody see that? Okay. Okay, now here's a question. Could I have come back, or could I label this as A, B, C, X, and then call that maybe A, leading diagonal wave A, B, and C? Could I say that this was an, in which case it'd be A, B, C, 5, 3, 5, in which case it would be a double zigzag? Could I identify the pattern that way, as a double zigzag, as a WXY? Ross, what do you think? Could I have done that and supported that case in front of my peers? Harry, what do you think? George, you want to weigh in on this? Okay. Well, the answer is yes. I could. I could say that this is A, B, C for W, X, A, B, and C. Okay, now this is where, again, a lot of people sometimes get frustrated with the wave principle, but they don't need to do that. Okay, could you call this a WXY? Yes, you could. Can you go with a flat correction? Yes, you can. Okay, whenever you're faced with two interpretations, always opt for the one which is more simple. So in this instance here, the ABC is a much more simple interpretation than the WXY. Okay. Also, too, one of the, say, glaring issues of the WXY interpretation would be the proportion between my wave C and my wave A. So whenever you come up with a wave count, ask yourself, okay, I'm going to label this chart this way. Now, pretend for a moment in your mind, just kind of close your eyes and say, okay, hey, if I sit in front of 5 people and they're on a podium higher than I am, and I got this chart behind me on the blackboard, can I defend this logically, utilizing the rules and guidelines? Think of yourself as an attorney or a barrister, okay? Because what you're doing is you're making a case, and you're using laws to build your case, okay? So yes, you can label this as a WXY, but the proportion between C and A of wave Y would be a little bit elongated. And I think in this instance here, I would always opt for the simple interpretation. Simply put, the ABC, okay? Again, I like to do everything with, again, understanding momentum. You have some basically, not really a bullish divergence here, certainly an oversold stochastic, rejection of RSI bull market support. I love this page. This is one of my favorite pages. This utilizes Larry Williams' %R tool. I utilize a dual %R, of course, with the candlesticks and the Donchian. And this was, again, a fun trade. I did get in a bit early. And just so you know, getting in early on a trade is really not my style. The only reason I guess in this instance here, I was maybe a little bit eager, and I don't like doing that. Just about every single trade example that I offer, you'll see that I get in late and I get out early. For example, the Sirius example, that right there is a great example of my average trade. I get in late, I'm not picking the bottom, I get out early. Sometimes many of you might consider it too soon, okay? I don't, because it's a profitable trade, and that's my job, make the cash register ring. In this instance here, this is one of the rare instances where I did indeed get into the trade early, but I trusted myself, I believed in the analysis, I thought it was solid. And then once we kind of saw the gap up here, does anybody know what this is? Old school chart analysis, gap down, gap back up. Anybody familiar with chart reading 101, old school Edwards, McGee, Bassetti work? Perfect. Yes. No, Bernard, it's not an abandoned baby. Maybe on the candlestick chart, you might have had one. Nope, not an abandoned baby. It's a bullish island reversal. And again, what happens here? I'm in the trade for really just a few days, 60% return. Hey, I'm fine. It gapped up the next day. Could I have made more? Okay, could I have made more money if I had stayed in the trade? Okay, yes, I could have made more money if I had stayed in the trade. Okay, but when it comes to analysis and trading, I do not trade could. C-O-U-L-D, could. Could, if, maybe, might. I can't trade could. And this is something very important. When you're an analyst, okay, your job as an analyst, and my job isn't that of an analyst, is to look at a market and to figure out what could happen. It could do this, it could do this, it could do this, it could do this, it could do this. You might actually be looking at 6 different scenarios. And your job, again, as the analyst, is to evaluate and say, okay, hey, out of my 6 choices, this is the scenario that I think has the highest probability of indeed coming to fruition. That's your job as an analyst, to basically study could, okay? As a trader, I have no use for the word could, or if, or might, or maybe. I cannot make money with could. I can only make money with is. Is the market going up? If it is, I'm going to be bullish. Is the market going down? If it is, I'm going to be bearish. I don't trade could, I trade is. Does that make sense? Okay, guessing, hope, could, those are words I strongly encourage you to eliminate from your vocabulary. because they don't translate well, or I think impact your trading in a positive manner. Roman, what do you think about this setup?
Well, yeah, I was thinking about that wave third and that entry. I have a tendency to enter earlier, and sometimes even much earlier. But in terms of the setup, I think that if I would be, and we were going through the Dow, obviously analyzing it together with our students. I think the big giveaway was the rally in the middle because it covers such a big distance from the top where the buying climax is on September 2nd into the ending of the wave A. So that kind of shows internal strength to come back to the previous levels where the selling was. And then the Dow had just a slightly different character than, let's say, NASDAQ or S&P. And here there's quite a lot of momentum to the downside. Probably would be difficult for me to enter on the way down. I would be entering probably on the way up as the price starts to confirm, the bullish bias.
Well, again, I totally agree with you on that. I tend to, again, this trade for me, even though it was profitable, again, is a very uncharacteristic trade for me. I look at a trade, for me, a trade is a party. Okay, and what I mean by that is I want to arrive fashionably late, make an entrance, and then I want to leave early before the cops come. So I want to show up late in a trade, because if you show up late and get in, say, here or even here, at that point you have price evidence, you have confirming price action, you have something on the chart that really does indeed support what you believe. You have that again. And so I 80-90% of the trades I take are, well, they're certainly not going to be this, but I'm never going to get in at the bottom. I'm going to get in late. Because again, a trade is like a party. Want to arrive fashionably fashionably late, make a big entrance, and leave before it gets too crazy and things start getting broken. but I think again, that's just my style of trading. It works for me, and maybe again, it may be something that many of you can actually take something away with.
Well,
Okay.
I think it's a great point, Jeffrey, because what does it mean to be late? It means that you come into a higher probability scenario. It means that the chart already, the price has shown you a confirmation of either the conditions, right, either bullish or bearish, then the true reversal that we see right after the ending of phase C. I'm sorry, wave C. And then you also could observe right away the character with which the price starts to move, which is very important because you want
Yes.
to get in not just on the reversal, but also on the correct character as how the price moves.
Yes.
Jeffrey, I wonder, and I understand what you're saying in terms of like, yeah, I'm profitable at that point of exit. I'm really curious about more of the technical explanation as to what is kind of like drives your decision at that point to exit, beyond just I made just the money already on.
Well, I really wish I could give you a like a really sophisticated answer, one that would
Simple
sound very
answer. Simple answer.
well. No, I mean there isn't one. A
Okay.
60% return on a trade that I'm in for 3 to 5 days
Yeah.
is a phenomenal return.
Absolutely.
And so I like to do a lot of these little trades. So I might do 1 or 2 trades like this a given week, and it's not like I'm throwing around a crazy a very large $10,000-$20,000 position. These are relatively small positions, but little by little, trade by trade, my P&L for the year goes in the right direction.
Mm-hmm.
I think a lot of times traders make the mistake of wanting to get rich quick, get rich fast, get rich on a single trade, basically buy a stock, hold it for 9 months, and then sell it at 100 or 200% return. I don't think that's realistic. I now don't misunderstand me. There's always going to be an exception to the rule. Years ago, I knew a trader that he started with $1,500 and within 9 months had the account up over $1 million. And I know this to be a fact because I sat down in a pub with him in London for 4 hours going through his trade statements for those 9 months, and he did it. It was amazing. I'd always thought something like that was more of an urban myth, but I met the guy that actually did it. And I think a lot of times most people tend to think that, you know, trading is one of those things where they're going to get into the market and okay, where was he Ross just sent me a question here. Where was he a year later? He still had his money because he exited the trade, got out of the market, and basically took a sabbatical for, I think, the next 1 to 3 years. So he quit when the quitting was good, pretty much. He left the party before the cops came up, Ross. So what I do is I look at these trades and I imagine to myself that these are bricks. So the way I can build, say, financial success, trading success, is not with one Hail Mary trade, but a lot of little successful trades. Okay, so that's kind of one of the things that kind of guides my trading style. I'm not looking to get rich on a single trade, you know, put 20 grand and do a, you know, 10 times my money trade and then boom, it's a great year. No, it's one of the things my father told me growing up, and I hated hearing it because I was 13 and I had an attitude. All the way up until I was 18, I had an attitude. But he would tell me, the hardest thing about doing a good job, Jeffrey, is that you have to do it every day. You just can't show up on Monday, do a good job, and then slack off for the remainder of the week. That's not how you impress the boss. That's not how you get raises. That's not how you move ahead. You got to do well every day. And I think the same truly does indeed apply to trading. You have to trade well every day. So I really do indeed focus on small, consistent profits. That's how you make a lot of money as a trader. Trying to hit the one out of the park, I think, and I'm sure I'm not the only one, where we've blown up account after account trying to hit that home run out of the market, or, you know, out of the ballpark. And yes, you can do it. It can be done. I'm sure we've all done it at one point or another. But it's hard to do that consistently, year in, year out. See, I still want to be trading in 5 years. I want to be trading in 10 years. This is like my own little business, my own little part-time job, and I love it. But I focus on basically small, consistent profits, week after week, month after month, and slowly you can, you know, build something spectacular.
Excellent. Thank you, Jeffrey.
Oh, you're welcome. Again, just kind of going back to reiterate a very, very important point, and a lot of people seem to not understand this. Again, other than this one Dow trade, most of the trades you'll see, most of the examples from me are going to be, I get in late and I get out early. But more often than not, it's going to be a profitable trade. So remember, you don't have to buy the bottom or sell the top to make money as a trader, okay? Another pop quiz for those of you who are kind of slacking off. I see a few people have left the room, but I understand it's late in the evening for many of us. What do we have going on here? Is this a good count or a bad count? Does this work? And Roman, feel free to participate. I can see where you are with your Elliott wave skill set.
I am absolutely nowhere, but I could give my answer. I don't know. Let's. I can try. Maybe allow others to answer first.
Well,
I see one mistake here.
Okay, what's the one mistake?
Well, it's the wave 2, right? It cannot be lower than the origin of wave 1.
Exactly. The answer is wave 2 can never retrace more than 100% of wave 1. And I don't want to split hairs and say, well, that works on a closing basis, but not on an intraday basis. Absolutely not. Wave 2 cannot retrace 100% of wave 1. Okay, moving on. Is this a solid wave count? Is there any kind of, and who knows, I might be trying to trick you. Does this work? Okay, people, just let me remind you that the devil's in the details. Okay.
Jeff, I personally don't know, but I'm guessing something with wave B and C in red. One should be above another or something like this.
Actually, no.
No. Okay.
Okay.
I'm gonna stop. I'm gonna.
No, it's okay. It's okay. Okay. Well, look at the substructure. Okay. We have the initial move down for wave A. Okay. The subsequent move up is wave B. That's also a 3-wave move. And then wave C is 5 waves. Okay. So this is a 3-3-5 wave pattern. This is a flat correction. Okay. And I apologize if I didn't make this clear, but the minimum retracement of wave B of a flat correction is at least 80% of wave A. Remember, the distinguishing characteristic of a flat correction is that it terminates at or near the origin point of wave A. So what you have here is, it is not, it's labeled as a flat correction, but it is not a flat correction. Okay? Let's try some more. What's going on with this? Of course, this is an ending diagonal, but are there any problems with this? Now, the reason I'm kind of going through these slides here is to reinforce that each pattern has its own unique set of rules and guidelines. And since I didn't clearly get into the details of the specifics that govern the development, wave pattern development of a diagonal, let me explain. Okay, the first move up, that first A, B, C, because wave B terminates at or near the origin point of wave A, this is best identified as a flat correction. You can't do that. Within a diagonal, each wave of a diagonal must subdivide into a zigzag and or a variation thereof, meaning a double zigzag. Okay, here in the wave 2 position, wave B is identified as an expanded flat. Again, you can't do that. Wave 1 must be a zigzag or double zigzag. Wave 2 must be a zigzag or a double zigzag. Okay, now there's not a problem with wave 3. Wave 4 also identified as a flat, but notice wave 4 does not terminate in the price territory of wave 1. That is a distinguishing characteristic of an ending diagonal. Now there's nothing wrong with our ABC structure. So I guess the point here is, even though this looks like an ending diagonal, it does not meet the requirements of an Elliott wave ending diagonal. So really what you would probably do is just say, okay, hey, from an old school analysis, this is a rising wedge, but it doesn't, rise to the occasion of an Elliott wave ending diagonal. So what is this mess? This is just an example of how not to identify a correction here. I would probably say what you're looking at, Bernard, if I was forced for a count, would be W, X, Y, X, Z, maybe a triple correction. Okay? What are we doing here? Is this a good count? Mike, you want to know the answer to this. Nancy, what do you think? Owen, weigh in. Bernard? Ted? Sean? Okay, wave 2 does not retrace 100% of wave 1. Wave 3 is not the shortest impulse wave of waves 1, 3, and 5. Wave 4 certainly does not end in the price territory of wave 1. So this does adhere to the rules that govern wave pattern development within an impulse wave. But the problem is it does not take into consideration any of the guidelines. And the primary guideline I'm referring to is the guideline, and this is Ralph Nelson Elliott's guideline of the right look, what I call the guideline of proportionality. This is actually what I refer to as a clown shoe wave count, okay? Because you got this huge wave 4 and this real teeny tiny wave 2, okay? If it looks stupid, it probably is stupid. So don't do that. If you're doing this, please stop it, because what you're doing is you're doing the wave principle incorrectly. And when you do the wave principle incorrectly, things will not end well. And at this point, let me just remind everybody, the wave principle is a tool, nothing more. There's nothing magical about it, okay? But as a tool, it comes with an instruction book, and you need to follow the instructions. Otherwise, you're going to be misusing a tool. Okay, for example, a car is a tool, and maybe it's just a regular Honda Civic, okay? Well, I'm sure somewhere in the owner's manual it says, don't put diesel gas into a regular gasoline engine, okay? A tool, I mean, we don't play with chainsaws, for example, because if you do, they're dangerous, okay? The wave principle is a tool, and I highly recommend that you use the tool properly. Otherwise, you're going to be looking up when you should be looking down, or you're going to be looking down and you should be looking up. Okay. Okay. In addition, well, I'll just kind of, because we're kind of, I'm trying to keep an eye on the clock here. This initially seems like it's an appropriate wave count. You got the 1 up, the 2 down, the 3, the pullback, and wave 4. But there's a problem here. Your 4, again, is not proportional with wave 2. So what you can begin doing at this stage of the game is you can begin to look and say, okay, hey, well, since the initial move down is a 3-wave structure, then maybe what we could do is another 3-wave structure up for B of a flat, and then come down in 5 waves. And then therefore your buying opportunities over here. Now you're adhering to the guideline of the right look. Now you have a wave count that is demonstrating better, or say a more idealized proportionality with its corresponding wave 2. Or what you could say is that this would be A, B, C, and then you would experience an X wave, and then another wave, A, B, C decline. Proportionality, very, very, very important. And again, just to kind of reiterate, things moving forward, if you do Elliott wrong, you're going to get it wrong, okay? So please do it right. It just takes a little bit of time, a little bit of practice, a little bit of effort on your part. And again, the book Elliott Wave Principle by A.J. Frost and Robert Prechter is really the seminal work on the wave principle. Okay, Roman, I got one more trade to go through, and then I think we'll be at a good maybe stopping point for this for tonight, if that's okay with you.
Absolutely, yes.
Okay, so what do we have here? Are we long or short?
I'm sorry, Jeffrey, you're asking me?
Well, anybody.
Yeah, okay.
This is open for anybody. Mike, you can weigh in. George, Bernard, what do you think? Anthony, Ted? Okay, everybody's got this nailed, so I'm certainly not. I mean, I was long. This is a buy-side trade, but I just kind of want to share with you for a moment again to demonstrate that technical analysis is a language, and I really don't think that there's just one best way to look at the market. I think there's several different ways, and that's why I'm a big fan of Romans and Wyckoff as well. Very, very valuable, and I think the two approaches do indeed fit in well. For example, looking at this price chart, over here we have a left shoulder, we have a head, we have a right shoulder. This is an inverted head and shoulder formation. With our 5-wave move up here, I would identify this down move, up move, followed by the subsequent decline as an expanded flat. So that could be wave A, wave B, wave 1, wave 2. So down here, I definitely know I'm going higher. Then you have this formation where you go up and down and then up and down. That's one of my favorite trade setups, my bar pattern trade setup. This is a double failure swing low. uh, just a phenomenal trade setup, whether it's to the buy side or to the sell side. So there are many different ways. Again, if you're familiar with the language of technical analysis, you can read this like a newspaper almost and know exactly what you should or should not be doing. Here was the wave count on an intraday basis. We pop up, we have this gap, clearly a 3-wave move, attempting to close the gap to the downside. Nice impulsive move up, down, another move up, down, again, double failure swing low 1, double failure swing low 2. In so many ways, this was kind of a no-brainer. Okay, does everybody follow? Roman, how would you look at this, either the short-term or the longer-term chart from a Wyckoff perspective?
Yeah, well, I really like the rally of the COVID low right there. It shows a lot of strength. And even though it goes to the previous resistance, that ability to exhibit a very bullish character with the gaps, increase of the spread, and ability to recover so many losses on the way down is bullish. I also like the reaction after the gap down in July of 2020. After that, when the price breaks the support, because the character of the move down changes. We kind of see that the texture of the price movement changes. And then, yeah, I really also like those late October or November setups, because those are just like higher highs, higher lows. There is a distinct buying character in just like a small gap and how the price moves. So yeah, it's just like such a great position before the move starts. And also, so this reaction into August, September shows non-availability of supply. And that suggests acceleration on the way out. So, and that's really good for options, obviously.
Awesome. Two great minds in agreement. I love it. This was, again, very simple trade, very nice trade. This one was really very profitable because I guess I did the, let me see, it was a pretty good price move that I was able to catch here. But again, just a simple one, 1, 2, 1, 2, caught the wave 3 of 3, bailed out of one at 186 return, bailed out of the second one. Again, it's opportunities like this exist, okay? And they may not exist every day in, like, say, the S&P, but they're out there, provided you know what to look for. And again, let me just reinforce, did I get in bottom tick? Did I buy here? No, I actually bought significantly later because there still was opportunity. This is a breakaway gap. This is an acceleration gap. Acceleration gaps almost always occur in the wave 3 position of a motive wave. So this is one of those, really phenomenal trade setups that come by being patient and knowing exactly what to look for. And that's important, and that's what I do in Traders Classroom, one of the services I edit or write for Elliott Wave International, where I basically, 3 times a week offer lessons on, okay, hey, this is what we do. This is how we use candlesticks. This is how we use momentum. This is how I use Elliott, and this is what you should be looking for. And, other tips and tricks on ideally helping people improve their trading. But no, this is an outlier, by the way. This was just one of those, I was in the right place at the right time. And that's why the returns on it were so phenomenal. But the earlier returns that you saw in those trades, where I would say on average, if I do a trade and it works out the way I want, I'm making 30 to 60% every time up to bat. This was one of those that just like, wow, really, really surprised. And then you start thinking, man, if I had just bought 10 versus 2, that sort of thing. But hey, it works out. Rome wasn't built in a day. It was built brick by brick, stone by stone. Okay. So once again, please just remember, because I see this a lot of times with my subscribers, they stress their biggest problems. They trade too frequently. Okay. They try and pick tops and bottoms because they're driven by, say, greed, wanting to make as much money as they can. And by trading too frequently, what you find yourself doing is you begin to take trades that really are not worthy of your time, consideration, or risking your capital. Okay. Think of it this way. and this is something I teach my students as well. Um, for me, I've got, 3 or 4 good friends, 3 or 4 lifelong friends. Okay, those I view to be quality relationships. Trading a lot of times can be so overwhelming because you're looking at so many different markets, and you think to yourself that you have so many different opportunities. Well, quality trade setups are just like quality individuals in your life, those people that you call your best friends. And that criteria that you have for those people that you let into your lives, that's exactly the kind of way you're thinking that you should have with before you pull the trigger on a trade. Does this trade I'm about to take, does it look like a good Elliott wave trade setup? Does it look like a good momentum trade setup? Does it look like a good candlestick trade setup? Can I back this up with Wyckoff analysis? Can I build a compelling case for doing what I'm doing? And if you can't build a compelling case, then I recommend, hey, maybe you need to rethink this. Maybe you shouldn't be trading that. Maybe you should be looking at something else. Okay, Roman, again, this is a great spot for me to terminate at, because I get into Fibonacci next. If you want to wrap things up or maybe weigh in.
Well, there are so many interesting kind of like trading nuggets that I'm picking up throughout this session. So, Jeffrey, thank you so much. Yeah. Um, there is, I mean, like one of the interesting things that I'm also picking up, it's just more on the mindset side, is that we think alike. And I like that we're thinking about trading in the same terms, like in the same type of like you need to do this in order for you to be successful, and it's universal, as you say, no matter what language you use, technical analysis language you use, trading per se is going to be kind of the same. You have to identify the environment. You have to identify kind of like the structural spots with the high probability of resolution, and then take profits. I mean, like, if anything, this message about taking profits. So sometimes I would be also the one who would wait more, especially with long-term strategies. Like there, it's kind of a little bit harder, um, to get out almost instantly, because you need such a proof of confirmation that everything is going to reverse and so on and so forth. So taking profits, trading the correct way, thinking about that trading is about making the money. It's not about figuring out what the market is actually going to do. It's figuring out how you're going to make the money no matter what the market is doing. And as Jeffrey has said, no position is a position. It's a cash position. And I totally concur that would I have stayed away from the market at some of the spots would have been much more profitable. So quite a lot of great, golden nuggets from Jeffrey today. And thank you so much. Let's see if we have any questions, any comments.
Well, Roman, let me just
Yeah,
jump in. I got one more
please.
story to share with everybody, and then we'll take some questions if there are any. One of the most impactful moments that really, I think that's when my mind began to shift in the right direction happened several years ago, probably 20 years ago at this point. I was kind of taking a sabbatical from Elliott Wave International, and I was doing day trading the E-mini NASDAQ. And the reason I did that was because I was a brilliant analyst. Okay. Well, the experience turned out to be a very unpleasant experience. I lost a bunch of money, but I learned a lot. And there was a period during that time where I'm sitting there frustrated. I'm pulling my hair out. It's just like, my analysis is spot on. But I'm looking at my P&L, and it's just like every day I'm bleeding money. And it's just like, oh, what's going on here? And then I went through And I basically had I kept a trading diary or trading log at the time. So I went back painstakingly and I looked at what time of day I got into the trade and at what time of day I got out of the trade. Because up to this point, it's like 80% of the trades I'm taking, I'm losing money. And I don't understand this because I just know in my heart, I'm better than that. Okay. So after 30, 45 days of going through trade after trade after trade, painstaking, what was my maximum open equity? What was my maximum drawdown? When did I get in? When did I get out? And I went through like 100 different trades. Once I did that exercise, I realized what my mistake was, because I realized over 80% of the trades I had taken at one point or another, they were profitable. I just was not taking the money when I had it. And then I went back and examined my whole mindset for trading. For whatever reason, I don't know where this idea came from, but I had the idea that every time I put on a trade, I was going to make $1,000. That was it. I was trading E-mini NASDAQ, and I would trade 2 or 3 contracts at a time. And it's like, I'm going to make $1,000 per trade. What the problem was that most of the trades would get to 800 or 900 or 600 or maybe 400. But I was holding on for that magic number, $1,000 mark, and rarely, if ever, did it actually come. Okay, so what I started to do, rather than focus on hitting a home run every time I put a trade on, I came to the realization that I can win a baseball game by hitting nothing but singles. So what I did was I made my profit target $200. As soon as I made $200, boom, I was gone. Took the money and ran like a thief. Okay, and when I started to do that, when I started taking profits when I had them, my equity curve started moving up with a nice slope to it, and I never looked back. So the point, 2 points to the story, or 2 morals of the story. What was the problem with my trading? Me. It was my mindset. I was the problem, not anybody else, not my skill with the wave principle, not the tools, not my charting software, not the newsletter I was reading. It was me. It was my mindset, okay? And I was able to fix it. The problems you create are your problems, but because you create those problems, you and only you, there's no better person. Bottom line, you're the solution, okay? You can get this. You can do this. If I can do it, you can do it, okay? So many times what we sometimes do is we have money, it's a profitable trade, we just don't trade it well. We don't manage it well. We don't manage the profits well, or we don't manage the risk well. Sorry to get a little bit long-winded there.
That was perfect. That was perfect. And there are so many, again, so many kind of like pearls of wisdom right there. I think what resonates with me the most, and I think a lot of people who would like to advance in trading, they're missing one point. You have to be kind of brutally honest with yourself. I mean, and this is what Jeffrey just did, and this is what he has done before doing that back testing. So basically, you have to say like, there is something that I'm not getting. There is something that I'm doing that is not profitable. What is it? So you have to obviously explore what it is, but before you do that, you have to have the willingness to be honest about your mistakes. And that's why sometimes when people like on social media ask us a question like, "Oh, you know, this or that," like I don't know, even like what your results are and so on and so forth. You have to give them everything, and just show like, I make mistakes. We all make mistakes. So I'm prone to mistakes, Jeffrey. I mean, I'm gonna show in the next session not just the winning trades. I want to show you guys also my losing trades. And Jeffrey, I want you to comment on those and how would you deal with those in those situations. So that kind of resonates with me a lot. So thank you for saying this.
Oh, my pleasure, my pleasure. And you're exactly right. the mindset are, if things are not going the way you want them to, there is a reason why. And I remember a long time ago, actually not that long ago, I was up in New York speaking at the Traders Expo, and I was little, I don't know, maybe a little bit cavalier that day. I was speaking, but I had everybody raise their hand. I said, who wants to be a trader? And everybody raised their hands. I said, okay, the first thing I'm going to recommend you to do is you need to go see a psychologist. And of course, the whole room busts out into laughter, but I was actually kind of serious. And here's why. Whatever issue you have personally, consciously or subconsciously, if you do not deal with it and you attempt and try to trade, the market will give it back to you. It will take advantage of that failure, that inadequacy, whatever, and it won't end well. So you need to make sure that your head's on right, consciously and subconsciously, because you would be surprised, and I've got more stories about this, how even your subconscious can and sometimes does trip you up and cause you to fail as a trader. And I've got story after story of just, the evidence, at least anecdotal evidence, of where the subconscious mind of the individual is what's sabotaging their trading success. So you really, if you want to improve your story, and we can end on this note if you'd like, if you want to improve your trading, the best place to begin, honestly, after 20 years of doing this and losing a bunch of money, but also making a bunch of money, is you must improve yourself, period.
What a great ending for this session. I would love to talk about this more, just like, the mindset always fascinates me. And I think that when we just kind of like get the technicals under the belt, we get the process under the belt, we understand how to see our own mistakes and then in the post-analysis make an adjustment. It's all about yourself after that. And obviously, this is the hardest part in trading. Jeffrey, thank you so much for such a great first session, great start to the whole series. And hopefully, guys, you're going to have more questions, more comments next time. And with that, Jeffrey, your final thoughts, comments?
No final thoughts other than just to express my appreciation for to everyone who's joined me. I really enjoy doing this, as I'm sure you can tell. I love teaching, I love trading, and I love technical analysis. And I really appreciate, I guess, the camaraderie that we all share as traders, because the problems I face as a trader, trust me, I've blown up trading accounts, a half a dozen of them. I've had the problem of over trading. I've had so many issues, but these issues and challenges, I guess, is probably a better descriptor. They're not unique to me. I know for a fact you have them as well, because I talk to traders all the time whenever I'm on the road or teaching or in the classroom. We all share the same challenges. And so there is, whenever you do get a group of traders together, there is a certain amount of camaraderie that we do share, because we all face the same, sometimes, the victories. We've been there. The devastating, those trades that you wake up one day and boom, $40,000 of your account is gone. We've all been there. We know what that's like, so we can commiserate together, but we also can, I think, share in our victories as well.
All right. Well, thank you so much, Jeffrey, again, and we'll see you next week. Thank you guys so much. And just one last announcement. You will receive an access from us to the class page for this special, where you will find an uploaded video and the slides as well. So thank you so much.